Okay. The summary of the revaluation model. Can you see the slides? The diagrammatic representation. Can you see that? I want to make sure everyone can see before we move on. Can you see my slides?
Yes, we can see the slides.
Okay. So if you look at it, the revaluation model states that if we have a revaluation surplus, so I'm looking at the left, a revaluation surplus is recorded in OCI. Okay. While a revaluation deficit or expense is recorded in profit or loss. So in this instance, on 1st of January 20X2, what did we have? We had a revaluation expense, right? Or deficit, we can say that. And the total revaluation deficit that we calculated was 50,000. That is 120,000. That was the balance on 1st of January 20X1 minus the 70,000, which was the balance on 1st of January 20X2. So the whole deficit was 50,000. So you should be able to record the revaluation expense in profit or loss. However, if you're reversing a revaluation surplus, you first have to record it in other comprehensive income. All right. So in this instance, we had a previous revaluation surplus that we recorded in 20X1. And the value of the revaluation surplus that was there in 20X1 is 20,000. So first of all, we have to reverse that revaluation surplus. Okay. And then any excess will now record it as a revaluation expense in the statement of profit or loss. All right, one important thing that you have to note is that it is very important to learn the theory. As I said, it's very important for you to have the textbook. Go and read the textbook. Go and read the explanations as to why we're doing what we are doing. Okay, that will help you once you're dealing with your theory. Okay, so let's just do this. So what were we dealing with in this instance? If we go back to slide 11, here we're dealing with a decrease in fair value. So it says decreases in fair value are recognized in other comprehensive income as a reduction in the revaluation surplus. So in this instance, we had a revaluation surplus. However, any excess over the previously recognized revaluation surplus will be recognized in profit or loss as a revaluation expense. So if you don't have a previous revaluation surplus, the whole amount would be recorded in profit or loss as a revaluation expense. But in this particular example that we are doing, we had a previous revaluation surplus. So first of all, we reverse the revaluation surplus, and then the excess will go to our profit or loss. Okay, is that fine? All right, I'm assuming that that is okay as it relates to the example. So let us move on. Are there any questions before I move on? Okay, it seems then there are no questions. I want to share. I want to share my Excel book. I want to show you how we present this in the statement of changes in equity. You're not required to do this, but just so that you understand what is going on. So this is a statement of changes in equity. You've done the statement of changes in equity in first year. You didn't have this column for evaluation surplus. You dealt with share capital and retained earnings. So if we look at example on 1st of January 20X1, I'll highlight that. We don't have any balances. If you have balances, you're going to put the amount XXX. That just the X's represent the figures that you're going to put. And then we have the total comprehensive income for the year. The total comprehensive income for the year is made up of the profit for the year and then also other comprehensive income. So for 20X1, what did we have? For 20X1, we had our journal entry. Let me go to the journal entry. This is the journal entries that we just did. Okay. So for 20X1, this is what we did. We debited the land and we credited our revaluation surplus, which says is a component of OCI. So other comprehensive income 20X1 would have the 20,000. All right. That came from the revaluation surplus. It's not included in profit for the year. It's included as other comprehensive income. And it stays there. Now in 20X2, what happened? Let's go back to the window. In 20X2, there was another revaluation. The total value of the revaluation, in this instance now it's a revaluation expense or revaluation deficit. The total amount of the revaluation deficit is that amount, the 50,000. That's 120,000 which was given, or the fair value in 20X1 less the fair value in 20X2. So the total value of the revaluation deficit or expense should be 50,000. However, the standard says if there was a previous revaluation surplus, first of all, let us reverse the revaluation surplus. And we had a revaluation surplus in 20X1, that amount of 20,000. So how are we going to reverse it? Debit your since it was credited to reverse credit, we're going to debit. So we debit the revaluation surplus, 20,000, but then there's a excess now. The total revaluation should be 50,000, all right? But we have reversed it. We have reversed the 20,000 that was existing previously on 1st of January 20X1. We reverse that. And what is the difference that should be recorded as a revaluation expense? The difference that should be recorded as a revaluation expense is 30,000. Okay, so this 30,000 should be recorded as a revaluation expense. 30,000 plus 20,000 give us the whole reduction in the value of the land, which is actually 50,000. Let me just change this to a color that you can see. Is this fine? Fine. Okay, it's silence, so I assume that it is fine. So let us go back to the statement of changes in equity. In 20X2, let me actually change it this. In 20x2, what is going to happen is that we had a revaluation deficit, and the whole revaluation deficit was actually 50,000. So what do we do in 20x2? First of all, we have to reverse the revaluation surplus that existed, right? We have to reverse the revaluation surplus that existed. That means we remove it from the revaluation surplus account and we take it to our retained earnings account. Does that make sense? Hello?
Yes,
Are you
yes.
there? Can you see my statement of changes in equity?
Yes, yes.
So what we are saying is that in 20x2, there was already a balance. Let me put this balance. There was already a balance. Let me just make this bold. Okay. I don't know how much the profit was. I don't know how much the share capital was. But we had a balance in the revaluation surplus. That was the 20,000. Now we are saying in 20x2, we have a revaluation expense. Okay. So the standard says, first of all, we have to remove the amount that was existing in our evaluation surplus. And we remove it by crediting, or not crediting, debiting the revaluation expense, the revaluation surplus, sorry. We debit the revaluation surplus account with 20,000. And then what do we credit? We credited the whole amount that we credited was the land. But what is happening in this instance? It's actually saying that we've actually reversed a surplus that was existing. We have realized a surplus that had been existing, and we've just transferred that from the revaluation surplus to our to our retained earnings amount. So that is why under the revaluation surplus, now we have a minus 20,000 for 20x2, but then we just take that to our profit for the year. Actually, this shouldn't be in other comprehensive income. This should be here. This should be here. Okay. So the 20,000, this 20,000, we transferred that 20,000, we transferred it to our retained earnings because it's actually realized. And then what is this 30,000? This 30,000 here is the actual sorry. I want to just highlight the 30,000 itself. This 30,000 there is the revaluation expense or the revaluation deficit. So we have the 20,000 that came from the OCI that we're now putting as part of our profits. And then we have the 30,000 that was the difference, which goes directly to your retained earnings of forms part of your profit for the year. Is that okay? You are not required to do this statement of changes in equity, but I just wanted to show you what it would look like. But you are not required to do this. You are only required to prepare the journal entries. I just wanted to give you the big picture as to what it means when we remove something from OCI and take it to when we take it to the profits. So that is just all that I wanted to show you. So in total, for 20x 2, your profits would be reduced by the 30,000 and the 20,000. So the total 50,000, that is what your profits are going to be reduced by in 20x2. Okay? And that's where this 50,000 came in. So 120,000 minus 70,000. That's how we got to the 50,000. Someone says they can't see the slides. Okay, that was an old chat message. All right. Now let us go on to the example 4, which is the last part. Before we look at example 4, let us just go through this theory. A revaluation decrease. Oh, sorry, let me share the PowerPoint. I'll just share my entire window. Okay. We have instances where we have a revaluation decrease, just like the question that we just did. A revaluation decrease is not an impairment loss. All right. We're going to deal with impairments when we, that's the 4th unit that we're going to deal with this year. A revaluation is a restatement to fair value, whereas an impairment is a restatement to recoverable amount. Okay, this might be confusing. You might wonder, what is fair value and what is a recoverable amount? The recoverable amount is the higher of the fair value less cost of disposal and the value in use. Okay. So it might happen. Normally, when we say something is impaired, maybe it's damaged. So for example, let us say you have a vehicle and your vehicle is written off. Then the value that you've written off the vehicle by, that is called your impairment loss. But it's not all the time that when you're writing down to a lower amount, that it means there's an impairment that occurred. Okay. I want to illustrate this with an example, just so you can understand what impairment and revaluation is. So a recoverable amount is the higher of the fair value minus cost of the disposal and value in use. So an impairment, you write off an amount to the higher of the fair value less cost of disposal or the value in use. Okay, so I've put examples here. Assume these numbers are just theoretical. I've given you a fair value of 100,000, cost of disposal 10,000. So thus your fair value less cost of disposal will be 90,000. That is just the difference between 100,000, the fair value, and the 10,000 cost of disposal. Value in use, I've just put a figure of 120,000. So if you were to choose or to determine the recoverable amount, the recoverable amount is the higher of the fair value less cost of disposal and the value in use. So in this instance, the recoverable amount is 120,000 because 120,000 is greater than, let's see, let me put it here. 120,000 is greater than 90,000. Thus, the recoverable amount should be 120,000. So what does this mean? It means if you had an option of selling this asset, you would receive 90,000. But if you decided to use it, the present value of your cash flows that you could get from using the asset would be 120,000. So the entity would rather decide to use the asset than to sell the asset. Okay. So if we understand the recoverable amount and the value in use, etc., you don't have to know this in detail now. What I want to illustrate is the next part. Assume you're given a carrying amount of of 150,000. That's your carrying amount that you're given. Okay. And your recoverable amount is 120,000. The 120,000 is the one that we calculated there. You can write down, if you're using the revaluation model, right? You can write down this asset to its fair value of 100,000. And that fair value will not, or that write down is not going to be an impairment loss, but is just going to be a revaluation expense or revaluation deficit. So you can write down to an amount that is lower than the recoverable amount, and your asset will still not be impaired. And that's just because of the standard that you're dealing with. So a write down, a revaluation is a write down to fair value. It's not an impairment loss. It's not the same thing as an impairment loss, because an impairment loss is the write down to either the high of the fair value less cost to sell or the value in use, which is the recoverable amount. And that is not what we're doing. We're not writing something to the recoverable amount. We're writing something down to fair value because we are using the revaluation module. All right. So don't think that just because something decreases in value, it's impaired. No, that's not it. All right. So I wanted to show you this scenario just to show you that just because you're writing something down, it doesn't mean that it is impaired. And this is what this theory here is stating. A revaluation decrease is not an impairment loss. A revaluation is a restatement to fair value, whereas an impairment is a statement to recoverable amount. Okay. The term revaluation expense is used for the decrease in the carrying amount to fair value, and that amount is expensed in profit or loss. So when we expense something to profit or loss, we use the term revaluation expense. You may look in other textbooks, it might say revaluation deficit. It's not really that much. It's no different. All right. Um, okay. So we dealt with the revaluation surplus. We said an upwards revaluation is recognized as valuation surplus in OCI. It is never subsequently reclassified into profit or loss. However, the revaluation surplus may subsequently be used to absorb a revaluation deficit. And I showed you that when I was showing you the statement of changes in equity. How if we had a previous revaluation surplus, that a revaluation deficit may absorb any existing revaluation surplus that we have. I've already shown you the statements of comprehensive income and financial position and where the other comprehensive income component is. So we mentioned that you get your profit for the year and you get your other comprehensive income. Revaluation surpluses are always shown in revaluation in other comprehensive income. Okay. Now what is important here, let us look at the realization of the revaluation surplus account. The revaluation surplus account will be realized when the asset, in this instance, we're dealing with land, when the land is retired or disposed of. So you no longer use the land. The realization is done by transferring the balance in the revaluation surplus account to the retained earnings account, whereby you debit your revaluation surplus and you credit your retained earnings. Okay. There's an example here from GRIPPING GAAP. which is page 241, example 4. Land with the cost of 100,000 is revalued to its fair value on 1st of January 20x1. On 1st of January 20x2, the land is sold for $220,000 cash. What I want you to do is to go and do this example on your own. Okay? So what happens when the land is sold? So this will require you now to go and read the theory, all right? So that you can actually understand the journal entries that you would provide when you're accounting for such a transaction. The revaluation surplus journals will be quite straightforward because we've already done a revaluation surplus. So the first requirement, prepare the journal entry to account for the revaluation on 1st of January 20x1. That one is straightforward. But what happens? The requirement 2, prepare the general journal entry to account for the sale of land, okay, on 1st of January 20x2. I want you to go and do this on your own, and then this is where we'll start off tomorrow. Any questions? Are there any questions? It seems that there are no questions. Let me just check in the chat. Okay, those are old chats. All right. So it's fine. I will then meet you